All right, what is up, traders? Hope everybody's doing well. Today's lecture is going to be quite easy, quite light. Today, we're going to be talking about volume imbalances and liquidity voids, what they are, and how to identify them. So, we all know how a normal candlestick looks like. We have one candle open. Let's assume this is bullish. One candle open, the close of it, you have its wicks. The next candle open, its wicks, and then the pushes, close here, whatever, right? Now, a volume imbalance, which we will see quite often in the market, is especially in the futures market, is you have one candle closes and then the next candle opens. In terms of if we're talking about bullish, it opens higher. So there's a small space here. The wicks, they cover it, but there's a small space here that there's no candle, right? And then if we're talking about bearish, you have the next candle opens lower than the close of the previous one, right? So normally, if we're talking about bullish, this closed here, as in this picture, the next candle should open at the same price. But sometimes it opens at a higher price if we're bullish, and then it opens at a lower price if we're bearish. That is called a volume imbalance. And it's very important to note that because the key difference between a volume imbalance and a liquidity void is a volume imbalance, you have wicks that go through that price point, but there's just no candle. Now, a liquidity void is where you have absolutely no pricing, no trading in a certain space. So you have one candle that closes, you have its wick, you have the other one that opens, you have its wick, but there's still an empty space. There's absolute no paint in that region. This is a true liquidity void. And both of these, the volume imbalance and the liquidity void, they're like magnets for the market. And we can use them as PD arrays to go in the market, to participate in the market, or to close trades. So, and as I said, you're gonna see volume imbalances much more than liquidity voids. Liquidity voids, they're more rare to happen, and when they happen, they're like black holes. Like price will go back to them usually very quickly to fill up the gaps that there's absolutely no trading in. Whereas a volume imbalance, you're gonna see quite often, and it's a nice PD array to enter trades off of. So we've identified, or know now we know what a difference between a volume imbalance is, what liquidity void is, and how they occur. It's just a volume imbalance where the price of one closing candle and then the open is different. They should usually be the same. When they're different, that's a volume balance. And then a liquidity void is where same thing, it's a different price opening, but even the wicks, they don't overlap in that area. Like if for example, in this case, the wick was like this, and then the wick was like this. So they've overlapped. So in here, they've overlapped. So this now is the same as this, but just the volume imbalance now is bigger. It's from here to here instead of just this small bit, right? So this now would be a volume balance, but like so is a liquidity void and this will be the liquidity void. And then you just don't mark out the volume balance, you just mark out the liquidity void, right? But the volume balance here would be like so. So now that we've seen what a volume balance is and what a liquidity void is, I'm gonna show you guys a couple examples. This is from the NASDAQ chart. You can see here, boom. This is a nice example right here. We can see here, look at the upper prices. So this portion of the screen right here, right? The upper left. You can see how this candle, I'm on this green candle. Look at the closing price, C, right? It's right there. The closing price, it's 21,562.5. Now, normally the opening price of the next candle should be the exact same. It should be 21,562.5. But if we go and see the opening price of the other candle, it is actually 21,563. So the closing price of the previous candle was 21,562.5. The opening price of the following candle is 21,563. So there's 0.5 handles difference in price. And that, ladies and gentlemen, is a volume imbalance. And so you mark it out like so, right? So this is a volume imbalance. Now, I'm going to show you guys and tell you guys later on lectures how to and exactly how to use these. So don't worry. I just want you guys to right now just be able to identify them, right? Later, there's going to be a connection between volume imbalances and fair value gaps, and we're going to be connecting them all. All the dots are going to be connected, but for now, the beginning lectures, I want you guys to identify the key things that we use in market. So volume imbalances, that is a volume imbalance. In terms of a liquidity void, as I said, it's more rare to find them, but when they do happen, and usually when they happen, it's in new day opening gaps, new week opening gaps. What is new day and new week opening gaps? I'm going to go over them later. But for now, this is a liquidity void right here. This is a beautiful liquidity void. As we can see here, there is absolutely no trading between this region and this region. Yes, there's a wick, but there's no trading between here and here. And price will definitely look to fill this completely up. Okay, so price will definitely look to, in the future, fill this completely up. Okay, this is a liquidity void. It's like a magnet, right? It's like a black hole. It's like just the strongest magnet you'll see. Price will gravitate towards it and fill it as quick as it can. Okay, and there's a very, very nice PD array or indicator, you may say, in the market that we use to either take positions or exit positions, right? This is very beautiful. But for now, just look to identify what a volume imbalance is and what is a liquidity void. This is a liquidity void. And by the way, if we zoom in, we can see a nice volume imbalance right here, right? This is beautiful. Right there. You have from this candle close to this candle open. That is a liquidity void right there. Because if we look and see, look at the upper left, the close of this is 21,602.5, which is where it's marked by C. And then the open of this is 21,605.75. So you can see the difference in the opening and closing price from the closing of 21,602.5 to the opening of 21,605.75. So that's 602.5, 605. So we're talking 2.75 handles. Am I correct? No, wait. 602.5. Yeah. No, actually 3.25. 3.25 handles. Yeah, I believe 3.25 handles of a difference between this closing price and this opening price. So this is a volume imbalance, but this is not a liquidity void because we have trading that did happen in that region, right? We have this candle's wick and this candle's wick. So there is paint here, but there's no candles. So this is a volume imbalance. But on the other hand, this is a volume imbalance because there's absolutely no paint that is in this region. It's empty. There's nothing. So price later on is going to look to fill it, right? It's going to later on look to come down, fill it with candles. Not only wicks with candles, it's going to lay candles over it to look to fill in this liquidity void. Okay, so that's the lecture for today. Hope you guys found this insightful. There's obviously going to be a homework assigned with this lecture. Make sure to do it. And until next time, guys, stay safe.